You're the best. Thank you, Ty. Thank you, everyone. Nelson, Bill, we can waste no time.
For me? Got a hug?
No, it's not supposed to. It's supposed to be food. Where's the food fighting?
You ended last year with a hug, so we started this year with a hug.
I think that's only fair. All right. I know that you gentlemen are accumulating positions. I know you're doing great things. I want to make it easy for you so that you don't necessarily are pigeonholed by me, but give me your single best idea, first Nelson, then Bill, that you're building a position in right now that we don't know about.
Well, I will say we have 2 new positions which account for a third of our portfolio, unannounced.
Well, this is such a great opportunity to at least mention.
We're not ready yet, Jim. We're not ready. But I promise CNBC will be part of that knowledge when we're ready.
Are they food? Are they industrial? Are they American?
One is industrial, which we've announced. That we had 2 industrials. One has been announced, Pentair, which we're very excited about. The other one we have not categorized yet. We're going to leave it that way.
All right, fair enough. Bill?
We've announced, but no one's really noticed, which is, I think the most interesting investment we own today is probably Fannie Mae and Freddie Mac.
Well, let's talk about that because there are people out here right now watching who know that there's a $2 stock, Fannie Mae Common. A lot of people feel that the Treasury Department, government will never let that thing be worth anything. You obviously are making a statement that it's worth considerably more than $2 by saying what you just did.
For sure. I think it offers the most upside. Well, it probably has the most downside of anything we own. The downside outcome is very unlikely.
Is it an AIG situation where you eventually win a court battle, except for this time it pays off?
I think what's interesting about the AIG situation is we're not fighting the original deal with the government, right? Hank, I give him enormous credit. He fought the government bailout, but the government was the only money in town. The terms were harsh. The terms were harsh for Fannie and Freddie, but 4 years after the crisis, the terms were changed again with a negotiation between the Treasury and another agency of the U.S. government, right? So I just think that does it get resolved in a legal outcome? Possibly. I really encourage people to read the Amici briefs, including one by a former FDIC chairman about the impact on the banking system if the so-called Fannie Mae Third Amendment is allowed to stand. So I just think that you can't this cannot become a precedent where the U.S. government can step in and unilaterally take 100% of the profits of a U.S. corporation forever.
Fair enough.
And so I think that's going to work out well, but I think ultimately what will drive is not litigation, but the conclusion that Fannie and Freddie are really the only way to have a housing finance system in the U.S. with low-cost mortgages for middle-class borrowers.
All right, fair enough. Let's talk about the state of activism and whether David Faber and I talk a lot, Nelson, about whether the defeat that you suffered at DuPont is the high watermark of actual corporate challenge, and the Pentair is the new style of, listen, we want to work with you. You've always been a constructive activist, but the DuPont loss was a significant loss in a lot of people's minds because you had done a lot of work. The stock had run up to 80, largely on the strength of the fact that people felt you'd get in and you could make things change.
It's been a significant loss for shareholders. Stock's gone from 80 when I was on your show March 12th. It was my wife's birthday that day. And the stock was 59 yesterday. And you can add $2 to that for Chemours. But it's been a loss for all shareholders. And we had 46% of the vote. And the activists, the index funds voted against us. But we haven't sold our shares. That's not our style. And we're going to wait and watch and see what management and the board will do from here forward. And Ellen Coleman was in my office last week, and I said to her, the second least favorite thing that I'd like to do is have another proxy fight. But the first least favorite thing I'd like to do is to see DuPont next year at this price.
Would you buy more right here?
I would consider it, absolutely.
Are you?
We are not discussing that.
Would you buy Chemours here?
That's a good question. I don't know. We're doing work on Chemours. I mean, Chemours, think about that. That stock, when issued a couple of weeks ago, was 21 bucks.
Right.
Yesterday, I think it was 12. They over-leveraged the company. I mean, we're accused of smash and grab. We're accused of over-leveraging companies. Our white paper said, spin off Chemours, make it investment grade. They spun off Chemours, they made it junk, okay? They promised a $1 dividend. The market clearly
Saying it's 18%. There's no way that that's going to happen.
That's correct. So the stock 21 to 12, 80 to 59. Think what might have happened had we won.
All right, well, Bill, let's say you were involved and they didn't want you on the board and they voted against, the shareholders voted against you, including Index. Would you take your bat and ball and go home, or do you just say, listen, there's still a lot here and I want to keep working?
Look, I think Nelson's handled this very well. I mean, I think we were not a shareholder of DuPont. I think it seemed much too personal a proxy contest. If I ran a company, I would be delighted to have Nelson on my board. I think he's I really mean that. I mean, I think it's very, very helpful to a CEO to have a major shareholder on the board, so that you can get input from a shareholder before you can test something internally, which I think is very helpful.
Were you surprised about the denouement that they didn't want what were actually, I think, some pretty qualified candidates that Nelson put up?
Yeah, I was surprised by it, but I think I think the stock price is certainly a short-term reflection of the disappointment of the owners of the business.
Contrast that with Air Products, where you took a very big stake, and I know you were not that happy with management. Old CEO goes out, new CEO comes in, does a remarkable job, even in an environment where many people didn't think the industrials were that good. Is this the kind of activism that you think is sometimes necessary when you take a position and the company's not as well run as you think?
Look, I think we've made a lot of money in cases where a great business has been run by a mediocre CEO over a period of time. I'm not commenting about Air Products, but don't want to pick on anyone in particular. Maybe I'll pick on the former CEO of CP. I mean, a more extreme example. Right. If you can put a great CEO in to a great business, you can make a fortune. And if you can do that consensually, as we did in Air Products, they gave us a couple seats on the board. We picked a third director. One of the directors we put on was a guy named Seifi Ghasemi.
Right.
The board did a search, looked at the world, and said, you know what, Seifi's the best guy. To their credit, they probably didn't want to pick him because it was our idea initially, and then ultimately they concluded he was the best guy. He's done a great job. He's been there only a few quarters at this point.
Well, are you happy with Juan Ramon Aleix, who's done a pretty good job, I think, at Zoetis?
He's done a good job at Zoetis.
Does he keep his job?
That's really up to the board. I'm not on that board, but he's also
you have a big
65.
position, though. Are you happy with his work?
I'm just getting to know him. So I think look, I have to give him enormous credit. In a very short period of time, they've announced a major restructuring program that's going to make that a much more efficient company. I think it's a great business. He seems like a lovely guy. I just really haven't worked with him, so I don't know him well.
When you guys, I know that you're friends, but I also know that you do different styles of work, but both of high quality. Have you ever felt, oh, I cannot believe that Nelson got that one. That was the one that I was working on the whole time, and he beat me to it? Have you guys ever said, darn, that's the one that I know I could have done?
So a funny little story. So we bought a stake in Cadbury a while back, and we had never taken a stake in a UK company, had not been involved with the UK takeover rules, et cetera. We thought, this is really down Nelson's power alley. So I went to pitch Nelson on Cadbury and working with us on it, and he was fairly non-committal, not particularly interested.
No, it's good, Bill. You brought in candy bars, you brought in soft drinks.
Yeah, look,
and I'm easy to get that way with sweets and stuff like that. So Bill came to the office, not to cut him off, with all these goodies, and we had already loaded up on the stock. We were loaded up on the stock.
So he plays pretty good poker. So I left the meeting thinking, and then he shortly thereafter announced involved in the company. We just rode his coattails.
Did you like his work in Wendys and felt that Burger King quick serve, good place to be, or it just happens to be that you both like quick serve businesses?
Actually, Nelson is probably the only, or one of the few activists where we've crossed over a couple times. Actually, the story on Wendys is sort of similar, but a bit in reverse.
Right.
We had a stake in Wendys. Nelson was actually forming his partnership, and then 6 months later bought a stake, and it was very helpful. So I think, we've known each other now 10 years, and I think we like high quality businesses, and we like high quality management teams. And I think we'd like to work constructively with management, but occasionally, when you get the Heisman, I guess you'd call it, it's important to give the owners a chance to make a decision.
Okay.
Wendys is a very interesting example. That was the first stock we ever bought when we started our fund. We bought that stock in November 10 years ago, okay? And when you talk about activists and they talk about the fact that we're short term, they talk about that we want to leverage up, they talk about all this stuff, and we're still in Wendys stock. We're still in Wendys stock 10 years later. And what really troubles me is all the mudslinging that goes on to activists. They want to say that we're green mailers. They want to say we're the raiders of the 80s. It's not true. We're here
Weren't
to
you
make.
a raider of the 80s?
I was never a raider. I never was a raider. I did a unsolicited of National Can. That worked out pretty well. Okay, and we never had a lawsuit about it. Management stayed. It remained a public company. The CEO of National Can stayed on after we bought the company. And they put, by the way, very interestingly, on the front page of, they had a tender offer going at the same time, for a partial tender offer, and they said on the front page of their document that if anybody came in for 100% of the stock, all cash, at a higher price, they would deal with them. So we took them at their word.
Right, well, I mean, you clearly
Never been done before,
right? But you've had
since,
very, very different. Well, let's talk about a proxy fight where you won, Heinz. Okay,
Yeah.
you come in, and you discover what? That there were people who weren't necessarily doing what they wanted, that you weren't happy. Versus, say, Ingersoll, where you come in and you say, "Geez, these guys are pretty good."
No, I'll tell you. At Heinz, which was really fascinating, I love the company, I love the brands. I didn't know management very well. And like most management, the knee-jerk reaction was to keep the activist out. But we had a prescription for health that didn't include breaking up the company, that didn't include make it anything but investment grade, just saying, let's spend more money on marketing and let's give out less discounts to retailers, create pull versus push for the product. It worked, and I'm very proud of the fact that Bill Johnson, who's the guy we had the proxy fight with, is on our advisory board today, and he's our designee on the Pepsi board.
Well, then, so far, he's got to like the fact that they had the best consumer products growth story, the best organic growth. They had double-digit earnings. A lot of these other companies, Coca-Cola, a competitor, won't. He must feel that maybe that model is not as bad as one thought initially.
I didn't have a problem with the model. I had an overarching problem with the fact that I felt their expenses were too high. And I think Pepsi is doing a wonderful job. I think Pepsi is positioned themselves that they will meet or beat earnings every quarter from here on in, which will make all shareholders happy. Nothing wrong with that.
No.
But I think they could probably do more.
All right, fair enough. Well, Bill, you've got a couple things that, another way to go, you have a vehicle, Howard Hughes, that I think seems like it's been a fabulous opportunity. You have Platform Specialty, happen to have them on Mad Money tonight. Just really think they're terrific. A blank check company that's done well. Do you like the vehicle method? Do you like this where you've got a couple of shares that you're on the board? Which is the activist model that works? Or you just kind of feel, well, it's multidisciplinary?
So I think we do two principal things. We focus on very large companies that are undermanaged and where we think we can be helpful. Canadian Pacific, Air Products, businesses like that. We've also built some companies. Howard Hughes I'm proud of because this was a business that didn't exist. This was the general growth restructuring. We took 34 assets out of the company. We stuck them in a shell. We spun them off to shareholders. We recruited the management team, a board of directors, and took a bunch of development assets that the company had made no progress on in 10 years and built a real business. Stocks, I think, up fourfold since, maybe more than fourfold since the spinoff. And that's been a very good experience for us, backing a very talented team with either cash or a sort of a minimal collection of assets. We've done the same thing with Platform. Platform is really, Martin Franklin's, I call it a vehicle. It's a company at this point. It's a 10 billion plus, specialty chemical company. And usually we find the great business with weak management, but finding the great management without a business and backing them and building a company. What's interesting is if you look at our portfolio, almost everything we own today is what I would call a platform company. Right. So there's Valiant Pharmaceuticals where you have a great collection of assets, but a CEO with a track record of very disciplined allocation of capital and a great deal maker and a great operator. Right?
Look, I commend Bill for his platforms. I think it's a great way to do business. We did that in the 80s when you don't have much money, you buy vehicles and you do what you got to do, and that's how we created American National Can, Uniroyal Chemical, a whole bunch of, it's a wonderful way to do things. We'd like to hope that Pentair will be something like that at that point if they can roll up more businesses in their industry. They did a great job with Tyco, taking it in, getting a lot of costs out. We think they can do it again. Their tax advantage being based in in Ireland. So I think Bill's done a great job doing that, and I think it's a wonderful model that's time tested.
Well, let's talk about the notion of constructive activism versus people who feel they don't need to necessarily vote for what might be a good thing for shareholders. DuPont, the stock empirically showed that if you went with Nelson, it was going to go higher. And the moment that Nelson lost, it's pretty clear it went lower. That's pretty much what happened. There were people who, I believe, very smart people, who were even at this conference, who believed in you and knew that what your plan might have raised the stock price. How'd they vote?
Well, you know what's interesting, Jim? We got, as I said, 46% of the vote. And virtually every active manager, virtually every pension plan, with very rare exception, almost every mutual fund voted for us. They had to mathematically, because when the 3 index funds and retail vote against you, you better get a lot of votes from the other parties, and we did. My question to you is that if the election were held today, what do you think the results would be? Okay, so that's one of the reasons why we're sticking around. Look, we want management and the board to do a good job. It's not, we'd rather be rich than right. Okay, so if the stock goes to 100 where we think it should be in a couple of years under our plan, we're thrilled whether we're on the board or not. But if it's not, then we've got to look at all our options again. And I question whether those no votes for us would be no votes again, given where the performance has been.
Do index funds have to have a brain? I mean, are they allowed to not have a brain?
So I think actually I've had good experience generally with index funds. I don't know enough as to why they chose to vote against Nelson in that case. The Vanguard board invited me to meet the directors a month, 6 weeks ago. They are clearly very interested in being other than a passive investor. I think they're generally pretty thoughtful. We talked briefly about the DuPont situation. I think it's a bit of an anomaly. I think if I have to say, the biggest mistake Nelson made is he waited too long. It's not easy to win a proxy contest after the stock is up. How much was the stock up?
You're 100% right. I mean, we bought the stock high 40s, 50, and the stock went up to 80, and they're pounding their chest on TSR. That TSR was all occurred from when we got in the stock, but they were taking credit for it. Now they've got to take credit for it again.
Wait, are there areas that are just off limits for you guys? I never see you coming in on a tech company, even though they're tech companies that are loaded with cash. It would seem like the managements aren't that strong. Just not something you want to do?
When you put 10, 15, 20% of your assets in a business, you want it to be an incredibly robust, stable, predictable business. And the problem with technology is most technology companies are too dynamic. I mean, you wake up and there's a couple guys in a garage, a block from Stanford University, a couple women in a garage, and they're starting a new business that's disruptive. And I think, if you look at the kind of businesses that I think both of us like, we like businesses that can withstand the test of time, technology, commodity. I mean, I try to stay away from things where an extrinsic factor I can't control, whether it's commodity prices, interest rates, doesn't have a material
impact. We like businesses, and I think speaks to Bill as well, that sort of have moats around them.
Okay.
Okay, and technology is one that isn't. We have 3 verticals that we like, everything consumer, financials that we call financials without balance sheets, because we don't understand them, and then industrials / chemicals, businesses that we've been in our career. Operate in those businesses and so forth.
Have you ever got into one and you just said, oh man, this is a loser, I got to dump it, we don't even know about it? Somebody that took a 3-4% stake.
Not since we've been running the fund. Not since we've run, but historically, yeah, I've gotten into some where I wish I hadn't been there.
Can you share it with us?
I'd rather not, but there was a property company in the UK which I thought the world was lined up absolutely positive for what we wanted to do. It was the end of the 80s, early 90s, and the first Gulf War broke out. We were buying it under what was called NAV, and we got NAV'd.
Got it. Well, Bill, you've got a new one, Nomad, that we should talk about. I love the food business. I think it's fantastic. This is frozen food. They've got birds. They don't own Pinnacle, which I think would be a great acquisition for them. Nomad's got this great management team again. That industry is still ripe for consolidation. Are you thinking big, Nomad, or is it going to be more like a B&G Foods, where you build it up little niche businesses that Kraft might sell? Is this the next Kraft Heinz, or is this just a company that will slowly, methodically make a lot of money?
I think it's going to be a pretty dynamic business. We share the same executive chair with Platform, Martin Franklin.
Martin Franklin. We all know Martin from Jordan, one of the greatad investors. Does not promotional, don't know it, but Jordan's been an amazing company.
I agree.
Can Nomad be that for Jordan? Nomad could
Absolutely.
own many aisles of the food business if it wanted.
No question. It benefits by one, it's small, so there's a lot of potential. Two, it's a non-U.S. domiciled company, so it's got a territorial tax system, a lower tax rate. And plus, there's a lot of dynamic things happening. And you look at Heinz Kraft.
Right, that's what I'm thinking.
There are going to be a lot of assets going to need to be sold. This is a company that could be a very logical buyer, and we have one of the best deal maker operators as our leading the charge. So that's going to be a good story.
Wendy's been fabulous. Quick serve been fabulous. Could either of you fix McDonald's, or is it too hard?
Well, I'm chairman of Wendys, so I don't want to give them too many tips on what needs to be done. But if I wasn't in Wendys, and didn't have a strong feeling for management and the board, McDonald's might be a place we would go.
You would?
Yeah.
Why? Because balance sheet and name brand, nameplate?
I think there's balance sheet, clearly, and huge amounts of points of distribution, but the culture and the mindset at that company has to be turned upside down. And I don't know if they have the stomach to do it, because it's going to take a lot of quarters or maybe a lot of years to get that thing righted. And I don't know that shareholders are going to be patient enough.
So if you look back, 10 years ago, we went to McDonald's and said, you should adopt a model of refranchising all your stores. You should keep a small test group of stores. And you should, that's how you should run your business. And they sort of turned us down, but they took some steps in that direction. And then about 5 years ago, the folks at 3G called me up and said, Bill, we're going to take Burger King private. We'd love for you to participate with us. And by the way, we're going to take your plan for McDonald's, and we're actually going to implement it. Now, Burger King was in a much worse place than where McDonald's is today, right? You had a store base that's disaster. You had same-store sales that had gone down every year. They'd had 13 CEOs, I think, in 25 previous years. But it was in, 60, 70 countries. And the best businesses are ones where if they've been run poorly and they had 13 CEOs in 25 years and they still exist, that tells you something. In a very short period of time. Now, 3G, I think, took the business, I think it was 2010. So in 5 years, they've taken Burger King from worst. It's an honest way to being best in the space.
Come on.
The numbers are
and by the way,
and the management. I mean, the guy's like 25 is running. He's fabulous.
Bill's
Nelson's
right.
still in one country at Wendys, okay? So he's got a long way to go at Wendys.
But what we've done is we've adopted that model as well. We'll be down to roughly 300 stores.
But you also did let some go.
We say again?
In stock.
What we did do,
In the tender.
what we did do, Jim, at Wendys, is we held back the real estate.
Right.
So we have a royalty stream and we have a rental income.
As does Burger King.
Yeah.
Do you guys like the notion of the retail model, say at Darden, where you do a lease back or you do financial engineering? Do those things work for you?
I'm not a fan. Interestingly, I come from the real estate business.
Right.
But I don't like, if you own, if you're going to be in the business a long period of time, you want to control your real estate assets as a retailer, I believe, and as a real estate company.
Well, how about if you're a Sears, where it doesn't, which I know you know, where it doesn't seem like there's much way out?
Sears, I think, is a tough one. I still think there's a lot of asset value, maybe not much left in Sears Roebuck and Company, but there's, Eddie's taken a lot of the assets out of that business. But if you burn up $1 billion or $2 billion a year in operations, you can work through a big percentage of the value of your company over 10 years. So that's a tough one.
I want you each to name me an operator that you absolutely love, that you would never go after, that you emulate, that you just think, geez, these are the guys. You go into a boardroom, you say, you know what, you got to be like Howard Schultz at Starbucks. Or you got to take a look at what Mark Parker's doing at Nike. Who are the guys that you respect?
I think the guy running Honeywell.
Dave Cody.
Yep.
Have a quarter on Friday, I bet he makes.
Yep. He knows how to run a conglomerate.
Yes, he does.
Okay? There aren't a lot of conglomerates out there that we agree with. That's one that we do. they've proven their mettle, that they can run these diverse businesses. They know when to get out of them, they know when to get in them, and they do a great job. You know, you've got to earn the right to be a conglomerate, and they have.
How about Sandy Cutler at Eaton?
Sandy Cutler should not be the lead director at DuPont.
Fair.
I don't believe the lead director at any company should be a sitting CEO.
Interesting. How about someone you like?
I think I actually don't know the new management team at Danaher, but I've followed what that company has done over a long
Very
period of time.
smart.
It's an incredible business. They've
Making a
done
lot of right.
Amazing job.
Yeah.
Yeah.
I want to just go back to Fannie Mae. When you hear something like a Fannie Mae $2 stock, do you say, listen, it's just too hard, it's the government, I don't want to mess, or does this intrigue?
No, that's what Bill shines in those kinds of
Right.
things. That's not an area that we feel comfortable in. We like brands, we like franchises that we understand.
I had a meeting with an investor once, big institution in the UK, and I described our investment in General Growth, where the stock was 50 cents and what the whole story is. And he called it the sex and violence part of our portfolio. So Fannie Mae's in the sex and violence part.
Which is the favorite stock? Which is your favorite stock in his portfolio? Which is your favorite stock in his portfolio?
I don't know. What do you got,
I'm
Nelson?
going to take Fannie Mae because I know nothing about it, but I've got great confidence in Bill.
All right, that's fair enough. You must, one of these must think it's...
What do I like?
You better like DuPont.
DuPont. I like it at this price versus the price right prior to the proxy.
And just in general, economy fine for you guys. There's nothing that is. You're not going to do anything different off of what China's doing right now or what Europe's doing now. These are not issues for your business.
I mean, my macro focus is to find the business where you don't have to worry about what's going on in Greece. I mean, look, I think China is a bigger global threat by far. I think I would call it the rigging upward of the Chinese stock market is a fairly remarkable phenomenon, and I think kind of a frightening one. You look at the Chinese financial system, you look at shadow banking, you look at the amount of leverage, you look at how desperately they've worked to get their stock market up. I mean, if it doesn't look like, it looks worse to me than 2007 in the United States, much worse.
And would you invest in any companies that have a big exposure, or would you think about that for a target? That company does too much business in China. I'm concerned.
I would worry about it for sure. I think it's the total lack of transparency. I mean, when they put out a GDP number of 7%, does anyone have any confidence that's the right number?
None.
I think there's a big consumer opportunity in China. I think companies like Mondelez are taking advantage of it. And no matter where the market goes in China, people are going to be eating more and more Oreos in China, and that makes me feel good. But on the other area, capital items and things like that, I would be concerned about in China.
Look, long term, I think it's a great story. In the shorter intermediate term, you have to be somewhat concerned about the nature of that financial system.
All right, well, gentlemen, I want to thank you. Very candid. I have to tell you that I want everyone who's thinking about the Fannie Mae, you got to do the homework because it's a $2 stock, and I know it's been a wild trader. I don't want to do anything that can necessarily hurt people.
There's a lot of risk. Risk.
I do hope that when we find out which is the big one, that we find out on CNBC that if there's another one away from that. And I know that from the piece in Barron's last weekend, there's one more that we're going to hear about, and I hope that.
There are two more you're going to hear.
There are two more, and I hope that we hear about them on Squawk on the Street or Bad Buddy, whatever. But I want to thank both of you gentlemen for a terrific panel. I learned a lot, and I think that we can go make some money with it. Thank you.
Thank you.
Jim, thank you.